Hello everyone and welcome to my video blog. My name is Nrupen and in this video we will take a look on return on equity, also known as ROE. First thing that you should know about ROE is that it is not just any basic ratio. It is measurement to understand performance of business. ROE tells us how efficient a business is in generating profit. To get ROE, we divide profit after tax of business by its net equity. Net equity also means net worth of business. Therefore, ROE is also known as Return On Networth or RONW. Keep in mind, ROE and RONW are exactly the same with exact same formula. To understand how it tells us about profit generation efficiency of business, we will take a look on a small example. Ganesh Iron Works is business with net equity of 200 million and in year 2018 it generated 20 million in profit. So to get ROE, we will divide 20 million by 200 million. We will get 0.1 as answer. To convert it into percentage, multiply it by 100. So we can say that ROE of Ganesh Iron Works is 10%. Or in other words, we can say that against all resources that are available to Ganesh Iron Works, Ganesh Iron Works have profit generation efficiency of 10%. Now suppose there is another business known as Jignesh Iron Works and this business has also generated net profit of 20 million. But net equity of Jignesh Iron Works is 100 million, the half of Ganesh Iron Works. Now if we divide 20 million by 100 million and convert it into percentage, then we will get ROE of 20%. In other words, we can say that Jignesh Iron Works have profit generation efficiency of 20%. So in spite of both businesses making similar number in profit, Jignesh Iron Works is 10% more efficient in generating profit than Ganesh Iron Works. Investors like to invest in businesses that are more efficient in generating profit. Keep in mind, businesses that generate higher ROE, their stock trade for premium prices. Also keep in mind, ROE just tells us performance of business for current year. It have nothing to do with what will happen next year. Also keep in mind, ROE just tells about efficiency of business, not about efficiency of stock prices. While investing, investors mostly prefer stocks with higher ROE, but high ROE doesn't always mean higher price appreciation. A business with ROE of 25% can surely beat a business with ROE of 35% in price appreciation. ROE just tells about performance of business, not about performance of stock price. In general, we assume a business have acceptable efficiency if it is generating at least 2x to 3x times ROE against inflation rate. For example, suppose our inflation rate is 4% and a business is generating ROE of 8 to 12% consistently. Then we can say that business have good chance of survival. They are neither good nor bad. They will just exist in market without any good growth. A business with ROE of 15% or above can be considered as business with average growth. In long run, their growth will be visible on their books and also on their stock prices. But since growth will be slower, price appreciation can also be slower. Businesses that can maintain ROE of 20% or above are generally considered as businesses with high efficiency. They are usually considered as growth businesses. In general, businesses with higher ROE than 20% generate big appreciation in price. That's one reason why investors intentionally prefer stocks with higher ROE. One more thing to keep in mind is that high ROE stocks usually trade for premium price. High ROE businesses usually have very high PE. Therefore, while growth investing, PE is often ignored. Now, important question is, are management of businesses with high ROE are good? Answer is both yes and no. And reason for that is a business can have high ROE without growth in earnings. For example, suppose a business with net equity of 100 million generates net profit of 30 million. In this case, ROE will be 30%. Next year business fails to grow but generates profit of 30 million against its net equity of 100 million. Again ROE of 30% but no growth. In my last video I analyzed care rating. It is the stock that matches the given description. It have high ROE since last 5 years without any significant growth in earnings. This is why you should never blindly trust basic conclusion based on value of ratio or number. All ratios and numbers have their advantages and limitations, therefore never trust any ratio or number blindly. To be really sure the underlying business under high ROE is really good, you must also check growth in its earning. Depending on what kind of business you are investing in, there can be several ways to look on ROE. But in general, we can divide business in 5 categories to take a look on ROE. First is business with consistent low ROE. Businesses with consistent low ROE usually show 5 to 10% ROE each year. We can say that these are those businesses that are somehow surviving in market. In majority of cases, their profit margins are thin. Growth in earnings and business is extremely slow to non-existent. They usually do not appreciate a lot in price, and mostly we avoid investing in such businesses. Second on list are businesses with consistent average ROE. These kind of businesses show 10 to 15% or above ROE each year. Their profit margins might fluctuate a lot, but there is consistent growth in earnings and business. Their prices usually move with respect to what is current trend of market and industry. If market moves up, they move up. If market falls down, they fall down too. In bullish market, their PE is high. In bearish market, their PE goes low. Best time to buy stocks of such businesses is when they fall down with market, because in short term their prices may fall, but in long run they are destined to move up in price. Third on list are businesses with consistent high ROE. These kind of businesses usually generate 20% or above ROE each year. Usually their profit margins are high. Keep in mind it is not compulsion, but in majority of cases you will find high profit margins. Businesses with high ROE are kind of businesses which trade for premium price. It is hard to find businesses with high ROE with low PE. Therefore, while growth investing, most of the time we totally ignore PE valuation. Again, keep in mind that businesses with high ROE are kind of businesses which can fall in price in spite of good earnings. For example, if a business is reporting 30 to 35% ROE from last 3 years and this year reports 25% ROE, in spite of good ROE and earnings, price may exhibit downfall. Because after reporting strong earnings of 30 to 35% every year, a number lower than that automatically qualifies as weak number. Next on list are businesses with inconsistent ROE. These are usually turnaround businesses which are either generating negative ROE or very low ROE, like less than 5%. Price of their stocks rise quickly in case they report good ROE and then falls down again with report of bad ROE. Turnaround businesses usually transition from inconsistent ROE to stable ROE. When that happens, prices usually start appreciating. Price appreciation in turnaround businesses is usually higher than other kind of businesses. So in spite of business generating only 10 to 15% stable ROE, stock prices may see strong appreciation for time business successfully turns around. Final on list are those businesses that present surprise high ROE. These are businesses that are either presenting consistent low or average ROE from long time and now have suddenly expected to deliver ROE of 20 or above. Usually profit margins of these kind of businesses fluctuate a lot, and the sudden increase in profit usually comes from sudden expansion of profit margin. Therefore, there is general assumption that high profit margin usually leads to high ROE. In my stock analysis video, you might have seen whenever I find a stock with high profit margin, I always take a look for high ROE. Keep in mind there is no guarantee that you will for sure get high ROE with high profit margins. But if you find increase in earnings along with high profit margin and ROE is also high, then you have good business in hand to invest in. Personally, I like to invest in businesses that are supposed to see increase in net sales due to increased demand of product in market. All such businesses usually qualify under surprise ROE businesses. Therefore, while investing, I personally do not take a look on ROE because past ROE doesn't influence analysis in any way. Again, while analysis, I mostly prefer to look at balance sheet and income statement more than ratios and measures. And reason for that is all ratios and numbers are calculated from data available on balance sheet and income statement. It helps in avoiding errors that can happen due to lack of understanding of concepts standing behind use of some particular ratio or number. Finally, keep in mind, do not judge a business or management of business totally based on its ROE. A business can for sure maintain high ROE without growth in earnings, and a business that is maintaining growth in earnings can also have low ROE. With that said, thanks for watching this video and have a nice day. In simple words, book value is amount that shareholders will receive per share if business decides to sell all its assets and pay all its liabilities today. Now, though it sounds good in theory that book value represents amount you will receive per share, but reality is book value can be very deceiving number for two reasons.